Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Welcome back to another episode of Broker Daily Uncut. I'm your host, as always, Julian Barnes, the senior journalist here at Broker Daily. And welcome back to the studio, guys. Eva, Costa, how are you guys?
Good. How you doing?
Yeah, very, very good, thank you. It's been a busy week. We were just saying, every single time we get into this, we say, what are we going to talk about? And then we start chatting. We go, God, it's too much.
Yeah. How are we all going to fit it in 20 minutes?
Exactly. Well, I want to start, obviously, like we always do, with auction rates. Now, in the past, we've kind of gone, auction rates again. But right now, I mean, each time we talk about them, it kind of hits a new record of some kinds. Not always a good record.
Not a good record.
Yeah, not a good record
for
this
people
week.
trying to sell their homes. So what have we got here? The combined capitals preliminary auction clearance rate this week fell to 54.5%, which is the lowest level since April 2020, kind of COVID times. Auction volumes, though, 15.2% rise week on week to 2,681 properties. And that is still 8.1% lower than the same week last year. So, I mean, it's kind of better news a little bit for kind of, at least for buyers there, but it's still kind of subdued. Melbourne's obviously got the highest auction volume, but Sydney, so 997 auctions, which is up week on week, but a clearance rate of 51.8%.
It's basically the flip of a coin if your property's going to sell on the weekend now.
I remember it was, yeah, for sure. I remember it was way higher, and we were going, it's a buyer's market, and now
I remember discussing with Alex in January when we got back from holidays that it was up at around the 78% mark, and it was just going gangbusters, and then throwing in interest rate rise, another one. Now negative gearing properties, and it's not looking good.
Yeah, I'm just shocked at the effect this has had in such a short time.
Yeah.
Like we're 2 weeks past budget, right?
Well, that's an interesting point. So I kind of dug into that. We did Catality and PropTrack release their May house price figures, the median house prices, all the kind of indexing. And it was interesting what they said, because obviously in there, and I want to get into that, because there was a flat line this month of May. You're seeing quite significant downturns in Sydney and Melbourne. Obviously, take what you will from a median house price. There is a lot of stories behind those figures. But Sydney values are 2.1% below their kind of November 25 peak. But what the Tim Lawless of Catalyst kind of noted is that this downturn is actually quite much longer in the making, and he kind of pointed that it's not just the kind of factors right now of the uncertain kind of global environment, the interest rate rise, renewed rate cycle, and the budget. Obviously, these are going to 100% play, and I think that they are playing on the auction rates at least. But the kind of overall kind of trend within housing, I think, is larger. Would you say?
Yeah, there's a lot of things that people would take into consideration from our end as well, like servicing capacity is so tight. So even though someone might want to actually do something, they just can't.
Yeah.
So that does affect obviously who can buy and for what price. Sydney is so expensive. You certainly need an income above the average to be able to buy something.
Absolutely. And I wonder if you're seeing kind of under 52% clearance rates there. Do you think that's going to translate into lower house prices, or do you think the kind of Sydney market is like let's hold out, until better times?
It has been dropping for the past few weeks now, and I'll just go back to what Eva was saying with serviceability. What house prices have come down, your serviceability has dropped more than that price of that house. So say, for example, it was at $1 million and now the house is $900,000. Your serviceability has dropped more than what the house price has dropped. So it's just...
You're chasing your tail.
Exactly. You're just chasing your tail regardless of what you do. And that's with the 3 increases plus the negative gearing that majority of people would have put onto that property, where even if they want to buy it, they're just that little bit short where they just can't get it. And it's just a real... Even when I'm dealing with clients now, like it's now getting to the point where it's like it's tight for a lot of people when we're doing their servicing. And, as mortgage brokers, it's our job to figure out solutions for them, and we do find solutions for them. But if this was 2-3 months ago, we wouldn't need to be finding those solutions for them because they were servicing, with the major banks and all that sort of stuff. So,
yeah, I think there's a sentiment as well from our buyers where it's like, well, everyone in the media, we're talking about a crash and correction of the market and all this. And so they're like, well, should I buy now? Should I just wait a couple of months?
Yeah.
And grab a bargain?
Yeah, absolutely.
So there is definitely two school of investors or buyers there, where it's like one is like, well, I just buy when I can buy, and the other one that just a bit more.
They want to sit on the sidelines.
Sit on the sideline and see what happens.
And I guess that just depends how risk adverse you are. Some people like taking the risk, and some people just like to sit on the sidelines.
You're taking the risk of buying at a
Yeah.
high at the moment.
It's a classic. The uncertainty is opportunity, but it also is uncertainty within itself.
Yep.
I mean, you saw it in COVID, of course.
Well, I clearly remember in the GFC.
Yeah, of course.
I remember there was people and they were buying up, and it was a massive risk. But
it'd be interesting to see what happens moving from Sydney to Perth. So obviously, Perth. Some of the other capitals are still recording gains. I mean, they're slowing, but they're still recording gains. So Perth's interesting. So this month, it still did 1.5%, which in a normal city is a pretty good return on 1 month. But that's slowed. I mean, in November 25, for instance, that was 2.9. So it's almost half the speed of growth that it was. And obviously, Perth is one of those markets where there's a lot of different factors there, but there is a lot of investors there. And obviously, the price has increased so much. I think the median's over $1 million, according to Catality.
Yep.
So it'd be interesting to see kind of where that market goes in terms of, as you said, the serviceability can be tight in Perth. Obviously the supply remains tight, so it'll be interesting to see how.
Yeah, because for investors as well, they obviously go where buyer's agent or where the market tells them to go, where things are potentially growing. There is a time where, even though maybe Perth is still a good place to invest, they can't invest there, so they will find other markets, cheaper markets, to be able
They'll find the
to
Perth of 5 years ago.
to get in and
the regions, for instance.
There's not that many cities where it's still affordable. So
the regional markets up 0.6% in May, but 2.4 over the quarter.
Yeah.
So they are kind of bucking the
yeah,
trend
region
a
are
little bit,
definitely gonna probably be like
Well, they're going to benefit from it.
benefit
because
from
that's
it,
where
or
people's
city
money's
like
gonna take them
Melbourne.
further.
Yeah.
Where it's a bit cheaper still.
Kind of speaking on that, kind of trying to figure out where investors go. There's been a few kind of bits of data that have come out, both forecasts and looking, in the past, that I want to run by you. So the first one is kind of Westpac kind of brought out some new figures of kind of where they're seeing the investor activity going. So they said the proposed budget changes in the short term is going to reduce investor activity by quite a significant amount, 34%, I think they said, and overall market turnover by 20%. So a near-term slowdown, but then and prices obviously to temper. But within that, they kind of said that house prices will, continue to pick up. The overall kind of underlying factors are going to remain there, and it will also boost kind of house building as well. Is that something that kind of you're seeing as well? Is that there's, I guess that is that by that time kind of situation.
Yeah, definitely.
Yeah, like you said, the fundamentals, as Westpac data said, the fundamentals in the housing is still there. Not enough supply, not enough people building, and too many people coming into the country. So there just is not enough housing supply to house everyone. And until those fundamentals happen, prices are never going to stabilize. Like, we're going through a period now where you can say it has been going down, but this is just like a speed hump. I don't foresee it, plummeting for the next 1-2 years, because ultimately the fundamentals of we don't have enough houses remains, and it's clearly remaining. Like, there's no one's building. So I would agree with that. It will probably go down for a little bit. We may be in it for 6 months, a year, but I can't see it like in 3 years' time. I can't see us saying that it's still going down. It just like anything, the fundamentals just.
I think it's fear-based at the moment.
Yeah, 100%.
Yeah, absolutely. And on that other side, something that I found really interesting from the RBA. So they did some data of their own that kind of looked at the average age of investors, and that kind of paints its own picture, right, of where the kind of investor market is going. Obviously, there's loads of different anomalies within it, but they kind of said the median age of investors in Australia went from 45 in the year 2000 to 51 in 2023. Within that same period of time, so 2000 to 23, the share of investors aged over to 60 went from 12% to 28%, and the amount of investors that were under 30 halved. And we were just talking beforehand that, I was asking you about kind of what the kind of profile is of the investors that you work with, and that isn't necessarily reflective, but that's an interesting,
Yeah, because I guess we do deal with a lot of younger Australian that do want to, build wealth, just like the older people have done, boomers, and the one that benefited from negative gearing. So I do see that, obviously, I guess older generation have the means to invest.
Yeah.
But clearly we do see that our clients, they are younger and they do want to invest. They want to do the same thing. The fact that it's halved already in that period you talked about, it's going to be butchery in 5 years' time to see.
If that trend continues,
that's gone. We did some modeling in the office, on a basic, income couple looking to actually do what their parents did.
It's tough, yeah.
That's not happening.
There's
no service. It will not happen.
Without negative gearing, that's just a pipe dream now. Yeah. Unless your wage is just growing at such a rate that, it's 50 grand every couple of years.
And the thing that everyone says is, it's okay, they still do it if they buy brand new.
Yeah.
Brand new carries a premium.
Yeah.
Right? So if their parents, let's say, everything considered the same, could buy 2 or 3 properties at a median price, they cannot do that because the median price of a brand new house is not the same.
No.
Yes.
Yeah.
So it's not.
But
they cannot do the same thing their parents did. That is not true.
And then obviously the kind of changes right now.
So that would drop the figures even more, and that's really sad.
It is.
Obviously, time in the market is what creates wealth.
Yeah.
So if you start later in life, when you finally have a bit of a,
It'll be
saving
interesting.
capacity.
I remember where I went to an event. I think it was with Ord Financial that there was a demographer called Bernard Salt there, and he kind of talks a bit about this kind of intergenerational transfer of wealth that is going to happen. Obviously, it may impact under 30s slightly less, but this could kind of bring down the median age, right? Because you are going to see a new generation of Aussies that are going to have some wealth coming from their parents, and that those house price rises will slowly get transferred down. Do you think?
But
and
remember, we're not like in middle age where the firstborn get everything.
Yeah.
So you sell the house, you still have to divide that by 2, 3.
And don't forget, you're probably going to want to pay off your current debt,
and you want to pay.
Most certainly.
You're probably going to be in that much debt.
So they might just have one small deposit for the next property.
Because that generation had that mindset where we just pay everything off, like we don't have debt. Whereas as the generation that we're
become
in,
more normalised.
Debt's
very, very normal up until a very late age. Yeah. So, that intergenerational wealth is definitely coming over the next 2 decades.
Also, people want to enjoy their retirement.
Yeah.
They must sell the house and still be like, you're not getting anything. It's just, I'm
I'll see you in the Mediterranean.
I'm living the life. And obviously, it is expensive.
Yeah, I just think the mentality is a bit different and the way we are set up compared to that generation is very different. So I guess it will be an interesting sort of part of how that's going to play out.
Yeah, absolutely.
I think it's going to be as big as it's meant to be, or what they think it's going to happen. And when you have to divide, like even if you make $1 million on yourself, divided by 3 kids.
Yeah. Pay off your debt.
Pay off your debt. Like it might give you the deposit for the next property, but it's not. Well,
that'll bring us in a minute. We've got to take a break, guys.
Oh, sorry.
But that'll bring us in a minute. That'll bring us back to something I want to talk to you about in a sec. Back in a sec. Welcome back to Broker Daily Uncut. Now, before the break, we were all talking and digging into kind of the intergenerational changes in how people invest, how people buy homes. And that brought me to something else that we've been writing about this week, which is obviously some new 2% deposit home loans. And within that, I saw an interesting figure that kind of brings us back to that kind of change in culture, change in landscape that people now have to contend with how they buy homes and how they invest, which is now PropTrack data has shown that it takes Australians more than 5.5 years on average to save for a 20% home deposit. Because property prices, of course, are kind of continuing to outpace wage growth. That's something that the Labour government were talking about when they introduced this budget. To be honest, I think that's not that long compared to some people I've talked to when they've tried to save for a home loan. Obviously, I guess that depends where you are in the country.
Yeah.
But yeah, let's open that up. Like, how does that kind of sit with you? Where does that?
Yeah, I do like the idea that they're still launching 2% deposit home loan, or we've seen like Westpac with 95% not long ago. It does show that the very institution and people putting, the risk is with the bank when you borrow 95% or 92%, that they do still believe in the property market, not.
Yeah, it is interesting, right? Because you're seeing those losses. I'll just quickly, for the listeners, fill it in. So Connective's partnered with Skip to launch Connective Skip, which is a new low deposit home loan. It's 2%.
That's available for everybody.
Eligible borrowers to purchase with 2%, offering...
it's also for investors.
Yeah, for investors
which
as well.
Which is not the case for first-time buyer.
Yeah.
No, exactly. Yeah.
So it does open up a lot of doors, but I do like the idea behind that when they did their risk assessment, it's like, we believe in the property market, otherwise we would not be offering.
Yeah.
98% of the risk sits with them.
But do they have a postcode restriction on it?
Probably. They would have some sort of...
There'll be some
restriction on that, but it does show, belief and like the market's resilience.
And I probably agree with that. Like, all right, it is risky because if prices do go down, but I've mentioned in the segment before, prices aren't going to collapse. They're not going to crash because I know I constantly say it, but the fundamentals.
Well, let's say you took this out.
Increase property prices.
Yeah, let's say you took this out. Obviously, it's just been launched, but let's say you took this out a few months ago for a property in Sydney, and now you've seen
you've been in negative equity.
Yeah, now you're in negative equity.
Yeah.
So it is risky, of course it is.
But I guess that is then betting on the longevity of let's say the Sydney market, that it's not going. We're not going to see a crash.
And people do hold properties for
very
quite a few years in general.
Go into negative equity.
But then that's not where you would want to sell. Be like, well, I'm gonna actually wait. I bought a property in 2018. Like, it was going down in Sydney at that time. So, but at some stage I was minus 100, right? And it's like, well, today I probably doubled my money on that property, but. Yeah, it's not the time you want to panic and be like, oh, it's going down, I'm selling. So unless you're flipping property, renovating,
but this product
you would hold
that's not the product for you.
That's not the product, and you, they would bet on people having properties for 5 years at least. Yeah.
And obviously, I can see that and Skip and Connective have kind of outlined the profile of potentially someone, an owner occupier who might want this, someone who has got good income but might not potentially have the kind of the deposit requirements to secure a property. But in terms of investors, do you see like a good market for this, or is this kind of a niche product?
No, we will have investors doing this.
Yeah, no, I think.
Yeah, people don't want to, like, investors don't want to use their own money, right?
Yeah, of course.
That's what we do. So you will put as little as you can in your first property, hoping it grows, and then use the equity and go again. So the first one is the one where you technically have to put some cash in and then never again. Yeah. So the less you can put there, I guess technically the quickest you can go and have a second. This is not limited to first time.
No, right? Exactly. Yeah.
So that would get people into the market quicker, so there will be opportunities in the next 3 to 6 months. Yeah, if prices are going down as the media.
But with the changes in negative gearing as well, I mean, it's not quite as attractive, right?
No, if it's your first or the second, it's still people can still buy, right? Yeah. It will get to a point where it gets tricky, especially if you've had a few properties. But someone starting, like, the population talking about, like, in their 30s, that have 50 grand saved up. I beg them, do not wait, like, because it's now, like, you can do some good.
Look at the kind of auction clearance results right now. Like, there is options out there for people.
This is coming into play because this is where we're at the moment with property buying. And we'll talk in Westpac have now, for their investors, 95%. We're at that point now where deposit is somewhat, I wouldn't say out of reach, but it's becoming harder and harder. So unless the lenders start making it easier and easier to get money with, 2% deposit, 5% deposits, and whatever it is, there's not that many people that are going to be able to get on the property ladder if you just remain it at 80%. I was talking to my sister. She lives in the Netherlands, and they do 100%.
Yeah, they do.
You get 100% loan.
In the UK, you can get that as well.
And I was just like, you're kidding me. She's like, no, you can get 100% loan. I was like, oh, wow. So it's not uncommon. It's uncommon for Australia. We're just not used to that.
We used to have those.
100% loans? Oh, okay.
Long time ago.
Yeah. Must have been before I got into broking.
Yeah. No, that did exist. Like,
But
yeah.
I wouldn't be surprised if we get to a point where that's going to come back now.
Well, it's
because
like, come on, 90, 98.
It's
You might,
almost
like,
there.
not
you
even
might
might
as
as
well.
well.
You're putting a total amount in at that point, right? Yeah.
you might as well go to 100, get all the media because they're all going to go jump on it, and then
Yeah. Well, we're saying it's
We
publicise
technically
your
do.
product.
Actually,
5.5
on the
years to
family
save
pledge,
20%.
on the family pledge, you do 105%.
Oh, well, yeah, family pledge. Yeah, I get in
So-
that sort of
Yeah.
scenario. Yeah,
Well,
but just-
yeah, technically it's still, the borrowing
but a
capacity.
standalone
is-
product where it's just like me getting the loan. Well, you
Yeah.
can go up to 98, and I think it's the sign of the times.
Yeah, absolutely. And obviously, it says, 5.5 years to get a 20% home deposit? Well, 2%. It's 10 times less time, right? Yeah.
Well,
Look,
yeah,
if you buy in Perth, where it's still supposedly going 13% up in the next year, well, it takes you a long time.
Yeah.
And then
Certainly.
you're not even chasing your tail. Your tail is going.
Yeah,
Like,
yeah,
it's just-
absolutely.
It's
yeah,
not
yeah,
happening.
Yeah.
So yeah, getting when you can.
Just go to finny.com and book an appointment. One of us.
Exactly. Yeah.
Getting
You're not chasing your tail is going.
Yeah.
Well, on that note, we better take a quick break, all right? Cheers. Welcome back, Broker Daily Uncut. Now, obviously, we've had some CPI figures and a bit of a surprise there for some people. The annual CPI for Australia has fallen, eased to 4.2% in April, down from 4.6% in March. Still quite high, well above the target 2%. But major banks are kind of, as a result, viewing the result as supportive to kind of keep the cash rate on hold, at least at 4.35% at its June meeting. I think the meeting's on the 15th or so.
Yeah, somewhere around.
Yeah, so underflying inflation, the trimmed mean rose to 3.4% from 3.3%, which is obviously the one that the RBA often cares about. So, it could go either way still, I feel, but I guess watch this space.
Well, I haven't received any emails from the bank saying they're increasing fixed rates, so that's a good thing.
yes, that's good. Yeah.
Yeah, that's always because this
That's
is the
gone
kind of
quiet.
time where you start getting
That's
them,
usually
right?
the indicator that you get a few weeks out going, okay, they are expecting rates to go up. So
Yeah.
That's true.
no emails like that have come through. So, and again, like I would expect CPIs come down, house prices are coming down. So, it's doing everything
That
that,
kind of-
they say that they want it to do. So I kind
Yeah.
of see it going up.
That bump is kind of going past. I think Westpac is the outlier right now in terms of the major banks. It was retaining its forecast 2 rate hikes, not this time, but August and September 26. So they're expecting it's going to go to 4.8, while CBA, ANZ kind of see an extended pause in what's happening right now. So fingers crossed.
I think it would be clever not to go too hard with the hikes. With this plus what's happening with the budget.
Yeah.
I know it's 2 different issues, but it's definitely
they play into each other, right?
Yeah, that's right.
Yeah.
So I think that would throw another huge.
Yeah.
I think they're just going to hold them for much, much longer. Whereas the last time, I guess they were under a bit of pressure to reduce them. So they did.
And you've seen a mix. I believe that there's been none of the decisions recently have been unanimous. There has been some kind of debate as to whether this renewed cycle was going to happen in the first place. It's definitely, holds have been on the table in the previous.
Well, the last one, I think, increasing it only won by 4 to 5 at the RBA. So there was a lot of people that thought that they should hold in the last meeting. So I can't imagine with this data now and that sort of balance that they're going to increase.
Yeah, and as you say,
I hope they don't.
the banks aren't necessarily moving, and that kind of brings me on to something I wanted to ask you two about. Obviously we've had all these budgetary changes, and one of the big ones is negative gearing, right? And at some point, when the legislation if and when the legislation goes through, we are going to see all banks kind of changing their servicing, or at least the vast majority of major players changing their servicing. But as I've kind of gone through, I've seen that the speed at which the banks have kind of tightened their servicing policies is different. So Macquarie, I think, moved first.
Yep.
Then you had a slew of kind of NAB, ANZ, Suncorp, Great Southern, Connective Horizon. do it, but they're all kind of moving at different speeds. And my colleague Charlie on The Advisor kind of talked to a couple of brokers about, what's easier for brokers. Is it, let's get what's happening right now, let's air it out, let's make some clarity, or let's bide our time? Where do you guys kind of sit on that? What's kind of easier for you when you're operating with your clients?
I think it's very much depending on what the client can service.
Yeah.
So if they got some margin, it's like, well, it doesn't really matter. Let's just gonna approve whatever, rates are best for you, whatever is important for them. Now we also have a huge cohort of people where it's like, well, if you don't have negative gearing, it's not working for you.
Yeah.
So do you want to buy a brand new property? Most of them will say no. It's like, well, we need to put you with a lender that still apply negative gearing, and then we'll hold that pre-approval until you buy a property with negative gearing. There's still lenders doing this. Obviously, they're taking a risk there, but I'm sure they've calculated the risk there. But right now, that's what we've got to do.
Yeah, they must have forced it through, because in my view, obviously, the reality is that this is kind of the new reality we'll be living with, unless a new government comes in or something.
But also remember, there are banks that never had negative gearing calculators.
That's true. Yeah.
And you bank one of those where nothing changes, business as usual.
That's really interesting, and I guess that they've already kind of faxed it in.
Yeah, that's a different way to do it. But the thing is, for the average person, servicing will drop by 30%.
Yeah,
25 to 30%. To make that up, you'll have to get some serious pay rise. So it's again a now never type of situation if you are tight on your servicing.
What's the reasoning there for the banks? I guess is it that if they move, they have to make that decision of if we move now and update our servicing, then obviously it is more reflective of the realities that we're at play. But if we kind of leave it a little bit, then it kind of helps with business. Is that essentially?
Yeah, I don't know. It's
looking at?
interesting because with everything, Macquarie are like first to do everything. I guess they're just known to
That's
be...
their policy, right? Yeah.
They're known to be extremely quick on everything. Then you had all the majors slowly a few days later. But I don't know, is it capacity for these lenders?
Some are still holding out. I think it's Westpac and St. George are kind of saying we're just taking a kind of, they've updated brokers about what's going to happen, but they haven't said we've updated the
I guess it depends on how full they book are in investment lending. There's also, so many buffers already applied to investment lending. It's like, well, if we take off negative gearing, or if client actually doesn't get the tax back, they still would be fine. So obviously, I guess calculating is, are we going to get people into defaults and arrears and not paying their mortgage, or do we still want business and people will actually be fine without the negative gearing?
I guess if you're in risk in one of the banks, you've probably been busy for the past few weeks.
trying
to nut all this out.
It's risk assessment based on their book, really.
Yeah. It's just,
build all this in. Now, guys, just to round off, I wanted to pick your brains quickly because I have been doing a story that's kind of led me down a bit of a rabbit hole, which is obviously around e-conveyancing. Now, I'll be honest, I didn't know loads about e-conveyancing until I started writing this story, and now it's all I can think about. So I have to say it, interoperability reforms. There, I've said it. Basically, what's happened is the ASX has reached an in-principle agreement to acquire to sell its 49% stake of Simply, which is a challenger e-conveyancing platform, to ATI Group. Now, what is it challenging? It's challenging PEXA. I think anyone kind of in the industry knows PEXA Group. It currently processes around 90% of all property transfers. So it's a dominant, say the least, a monopoly, really. Now, the Australian Register's National Electronic Conveyancing Council and governments kind of thought this is not ideal with having a monopoly. I want to ask you about outages and that kind of stuff. So they wanted to introduce this kind of interoperability program that kind of means that everything will be able to share, and we'll be able to bring in some contenders and some kind of competition into like the e-conveyancing sector. That's obviously fallen through. I mean, it was paused in June 24, and I think it's been formally abandoned by ARNEC in 31st of March 26. So right now it's unclear what's going to happen, and it's unclear kind of the future of Simply now ASX has cancelled it. But I wanted to ask you off the back of that story, as I said, like I've dug into it. What's your relationship with, e-conveyancing? How does it work? And are there any kind of road bumps from a broker's perspective on this?
Yeah, well, PEXA is it, right?
There's no other choice. It's
no
either
choice
PEXA
except, or paper in Darwin. And
well, that's
Darwin
why they don't
paper,
have. That's why they don't have 100%, because in Darwin you see
you got
paper.
10% of
So
Darwin.
they'll soon have that.
And look, and PEXA is good.
Yeah.
But there's issues, and when there's issues, there can be massive massive consequences for buyers and sellers. So when they are outage and things go wrong or whatever happened in there. The other thing is also they fix prices the way they want.
Yeah, absolutely. I mean,
There's no
You're not
competition.
challenging that.
Yeah.
Go somewhere else.
if you had one brokerage for the entire Australian market, it wouldn't make sense, right?
Yeah,
So
and you can't say, look, I'm not paying that. I'm gonna do a paper settlement. Your solicitor would be like, oh, no, not doing that. So it would have been great to have a bit of competition for sure.
Yeah, I guess it's not dead in the water right now, and I think it's definitely something that there was quite a strong reaction.
There's
when
no
we did the
federal
piece.
backing from what I understand there.
No, it seemed that there was kind of technical issues in doing it. It obviously ran on and it couldn't get over the line. But obviously that this is still a live issue, and I don't think it's over yet. And obviously it's important to say simply has been bought, and that
Well, I hope it does work out because competition is good for everyone. Like Eva was saying, PEXA are currently in a position where if they increase their fees, there's no negotiating with them to say bring it down. But if they increase their fees and there's competitors, well, I'll go to your competitor. So that brings prices down. That helps with, the service that they provide as well. Because again, if they don't provide good service, where are you going to go?
It's good for them, right? It's good for any company to have that competition.
Good for everyone. It's like when you go to Service New South Wales. Well, if they treat you bad, well, go somewhere else. You can't.
It's not just
you know
price,
what I mean?
it's, it's also like innovation and new ways to do things that, PEXA, they just, if it works for them, they're not going to...
Which is so important. It's how we
shit.
got to e-conveyancing in the first place, right? 100%. It's that through competition, through people innovating and trying to create new products. And, to push that forward is always a good thing.
Because there's still like a lot of that can go wrong within a settlement, and you'd think, well, it's all electronic, it's all there.
Yeah.
How does it still
in
go,
this day and age?
How does it still go wrong? But it does.
Yeah.
So there probably would be some ways to better, have discharge that don't take 3 weeks because the system can just, get the payout figure there and off you go without bank retaining clients like for more time than it needs. Like there's a lot of things that could be done better.
Mm-hmm. Absolutely.
That's
guys, we better wrap up there,
back.
I'm afraid. It's been an absolute pleasure, as always, to join you both on the podcast. If people want to find out a little bit more about Finni, where's the best place to reach you?
Finni.com.au. And there's a little bit of a calendar there where you can book a time to chat with one of us.
Ideal. And obviously for Broker Daily, it's brokerdaily.au, all the news, features, all the good stuff. And of course, we've got Broker Innovation Summit and Awards coming up. So go there to check that out as well. Thanks very much, guys, for joining us. And see you next week.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.